Good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to Coach's Corner. My name is Brandon Wendell, and I'll be with you for about the next hour as we discuss correlations in the markets, just general markets altogether. So we can look at all different ones, futures, Forex, as well as equities, and figure out how we can use some of those correlations as an odds enhancer when it comes to our investing and or trading. We'll go ahead and talk a little bit about that. And let me just get the chat up here so I can see that. Cool. Awesome. So good afternoon, Kevin. Welcome back. And Jim, welcome. So welcome to everybody here. There's quite a few of you. And like I said, we'll go ahead and kick this off in just a moment. But before I get started, I just need to remind everybody that neither Free Management Partners or news personnel, registered broker dealers, or investment advisors. I'm going to look at different securities. And just because I look at the securities doesn't mean I'm telling you to buy, sell, or hold those securities. I'm not telling you they're good, telling you they're good for your portfolio. And we're not doing any personalized advice or recommendations for your trading. Any mention of any particular security, I already mentioned that it's not a buy, sell, or hold recommendation. And there's always risk involved in the markets. No matter what we do to try to minimize the risk, you can never eliminate it. So, fix my bow tie here. So got my bow tie on today, as usual. And also, we're not subject to trade restrictions. I can have a position, initiate a position of security at any time. So just a couple more housekeeping things here. I'd love to have you join us for some of our free workshops that we do. We have obviously the Coach's Corner. You're here now every Friday, and the Power Hour we do on every Monday. That's Rob's thing. He goes over a specific topic and kind of looks at the markets, and those are free for you to attend at those particular times. So you just have to enroll. We do have some premium workshops coming up, quite a few of them. We're keeping pretty busy here. And also we have a couple other things going on. The Power Option Plays, Cover Call Explorer, Mastermind Group. My program is the E-Mini Think Tank. In the E-Mini Think Tank, we meet up on Monday, Wednesday, Thursdays from 9 to 11 in the morning, and we apply a lot of these strategies I'll be going over with you. So if you're more than welcome to join us there. There's a link in the chat for you to be able to join us if you're interested. So we have two different models there. You have a quarterly subscription or you have a monthly subscription. With the quarterly subscription, you always get a 2-week free trial first. If you like it, you just stick with it. If you don't like it, walk away. No big deal. We don't charge you. So anyway, we're also available on pretty much everywhere. Websites, Facebook, all that good stuff. I got my own personal ones too. But anyway, you can stay in touch with us online quite a bit. But let's jump into it. I want to talk about correlations because when we're looking at longer term moves in the markets, okay, I'm not talking about day trading here because day trading correlations don't matter as much, although they can be important to us. But what happens is when we're looking at the markets for a longer period of time, we want to have the odds in our favor. I mean, we do that no matter what time frame we're investing or trading on. Excuse me. We always want the odds in our favor. So whatever we can do to increase those odds, we owe it to ourselves to do that, especially if it's something relatively simple. Markets, it doesn't matter which market it happens to be. It could be Bitcoin or it could be the NASDAQ. It doesn't make a difference. They do not move in isolation typically. Unless there's specific news on a security, they will move in relationship to other related securities. And we see this on, like I said, a regular basis. By knowing what is related to your security, you can do a couple of things. For one, we can create a list right here. And we'll increase the size so you don't have to squint to read all that. There we go. So for correlations, it's really just analyzing movement of a security relative to another. That's all it really is. You're just looking to see how does one security move in relationship to another security? Do they move together? Do they move opposite? Do they move non-related? And the reason why we want to know these correlations, well, one is if you're building an investment portfolio, you should have non-correlated securities. Can't type today. You know, if you're holding securities that are highly correlated, you're basically doubling your efforts. And rather than spreading out your attention and your money investing in the same thing with different tools, it's better to put it all into one focus. You can manage it better and hopefully get better rates of return. You're putting more money into one particular investment. If it's a good investment, you make more. If it's a bad investment, well, that's where your stops and your analysis should prevent you from losing too much money, right? So when we're looking for an investment portfolio, we definitely want to look for non-correlated securities. So if we have extra money to spend, we're doing it with individualized opportunities that have no basis or no bearing on what happens with something else. So when market crashes, you have diversification. It's pretty much what it comes down to. Now, another thing we can do is look for correlation or correlated securities to lead another's movement. We're going to talk a little bit about this. I can't spell again. Geez. Teach another's movement. What that means is there's often times where a particular security will lead another security, sometimes by several weeks to several months. And that's pretty good. If you get a lead time, it's almost like having a crystal ball where one security can tell you what another is likely to do in the future. And that's obviously an odds enhancer, right? We would all like to have that crystal ball. That's what everybody is always searching for when it comes to analysis in the markets. They're looking for what can tell me what's going to happen next. And if we can find a security that's leading, then that's awesome. Many, many years ago, it was, again, this is not now, but I'm talking about probably 1999, 2000. It used to be Cisco. I think it was Cisco or Intel. I can't remember which one it was now, but it would lead the S&P 500 by 4 minutes. So what would happen is Cisco would be rallying and then start turning to the downside. And you can almost put your watch by. It was 4 minutes later, the S&P broad market would turn down. That was when it was one of the heavyweights on that index. And then it would, if it bounced, it did the same thing. And 4 minutes later, boom, to the second, it would turn up. People started realizing this, unfortunately, and they started front running. So then it became 3 minutes and 59 seconds, 3 minutes, 58, and so on, till eventually there was no lead time. But there are still securities, and we'll go and look, and I'll show you how to find some of those today. So correlated securities could lead to another's movement. Okay, again, we get the crystal ball. Number 3, even if they're not leading, correlated securities can offer confidence. So if you're seeing that 2 related securities are both hitting a buy zone or both hitting a sell zone at the same time, and they're turning, that makes you feel a little more confident in the position that you're putting in. Because, if it's working for this security, it should be working for mine. And if they're very highly correlated, then it will likely work. So that's something else we can look at. Another thing with correlated securities, offer cheaper trading. And what I mean by that is you can say that some have lower margins. Prior to the introduction of the micro futures, this was really important to a lot of traders and students of mine, because what would happen is they couldn't afford the overnight margins when it came to some of the futures markets. So instead, you could find currencies that would mimic the futures markets. They were highly correlated, 90% or more. And you could substitute a currency pair for a futures trade. The advantage of doing that, if you're not familiar with the Forex market, currency market, is you can trade what are called micro or mini lots, therefore reducing the size you are trading and your risk, as well as the margin. So you're going to trade, for instance, the S&P 500 and the Australian dollar and Japanese yen have a high positive correlation. We're going to go into some of those, like I said. But like I said, as an example, the S&P 500 has a margin, I forget where it is right now, it was about 11,000. I think it's like $14,000. I'll have to take a look. Oops, 14K. Actually, I'll let you know exactly right now. If I get to the right page, there it is. I was looking at gold earlier today, and we're holding a supply zone. So ES is 12,100. Margin. And of course, now we have the micro, which is available, right? So the micro, it's MES, and that's going to be a lot less. That is $1,210 margin. However, as I mentioned, Australian dollar, Japanese yen, will often mimic. And the nice thing about those currencies is you can trade for a lot less. So you can do a standard lot of 100,000. And I'm not sure exactly what the margin is right now on that. Let's see if we can find it. Go into Forex. It doesn't give me the margins right there. But let's see if I do yen and I go to put in a position here, it should show me. Let's do buy custom with bracket. And it shows that, what size did I put in? That's what I need to change. Let's do it with stop, it doesn't matter. So that's not the right size. That's a standard lot. So if I go confirm and send, you can see that's $1,548. That's the equivalent, by the way, of a standard. So that's 1540. Yeah, 48, 1550, we'll call it. It's close enough for government work. So there you go, 1550. But then we have what's called a mini lot. And with the mini lot, that is simply trading smaller size. And that is only going to be $150, basically, or $155 technically, of the margin. So you can trade a smaller size, and we can even take this down to a micro lot, as I was saying, which is simply 1,000, and therefore your margin is only 15. So you get to participate in the broad market and the moves for less margin, and of course, less risk and less reward. It goes both hand in hand. You can't reduce your risk without reducing reward. If you find something that can, let me know, but I don't know if there's of anything. So substitution is something else. Also, the last thing would be timing for trend changes for correlations. So we'll go there and I'll say correlations breakdown. Often precede trend changes. Let's see. All right. So there you go. It's kind of an example of what we can be doing when it comes to these correlations, how we can use them to our advantage. And there may be some other applications as well that we'll get into and discover as we go along. So let me just copy this note. There we go. Let's keep that off the side. So I make sure I hit all those points today. Really what I should have done is this. Copy. Create a new Word document. Actually, I already had something open. I just paste it in there. Either way, we're going to cover all those. So that's kind of what we're doing here. So once again, correlation, when it comes to an investment portfolio, we want to make sure we have non-correlated securities. Now, in order to find some of these securities, whether they're correlated or not, there are several different tools out there available to you. Most of the time, depending on your trading platform, you should have some sort of a correlation tool that will allow you to analyze two securities at a time, one against the other. You might be able to find some heat maps or what they call correlation maps on different websites. That's also helpful. And again, I'm not telling you exactly where, you just go out and search. Just look for correlations. If there's plenty of them, if you're looking for currencies and a few of them for futures. Stocks is a little trickier. Let me see if I can post those notes there. Oh, it did. So now I got a Word document there with the correlations, what we're looking for today. Perfect. All right. So one of the websites I like to use, actually, I might as well keep it. So many things open. Close this out. No. So one of the websites I like to use is absolutely free if you go directly to this portion of the website, But if you decide you want to subscribe to the site, there's also a lot of useful information there too. It's called MRCI. And the portion I go to is www.mrci.com/special/correl.htm. Let me copy that. There you go. And I'll put that into the chat so you have it. Now, this is for futures. However, it will work on multiple securities, and I'll show you how. So if I click directly on that, there we go. I have to hit Control and click on it. Should open up the browser there. And it's kind of already there, but there it is again. It'll show you MRCI inter-market correlations, previous 180 trading days as of yesterday's close. It always gets updated at the close of business for each day. So what we're seeing right now are the market correlations for different futures. And you can change this 30 days, 60 days, 90 days, 120 days, and so on. So what you see, it starts off with the Dow, moves to the S&P, NASDAQ, Russell 2000. And then we have the Nikkei 225. It looks like they took off the mid caps. It was there for a while, but they got rid of it for the small caps. Treasuries. Now, euro dollars, don't confuse that with euro forex. Okay, euro dollars, that's ED, and that's curable with little blue pills. No, just kidding. But ED or euro dollars are futures on the amount of US dollars currently being held in European banks. It's kind of a weird one. Yeah. So every European bank, probably including Switzerland, I'm not sure about that or not, but they report every day how many US dollars are being held in their bank accounts. They don't tell who it is necessarily, but they tell how much is there. And that number is traded. It's a tradable security. It's kind of interesting. Anyway, we get into currencies, Swiss franc, euro, forex. You see, it says that. And if you hover over the label, it tells you what it is. So once we get to dollar, then we move into commodities. We have gold, platinum, silver, copper, and so on. Get to energies. Keep going. You've got softs, coffee, cocoa, sugar. Then you go to grains, wheats, soy meal, soy oil, cotton. It's another soft. And then lumber. Or I'm sorry, no, that's cattle. Lumber's towards the end here. There it is. So you got the cattle, live cattle, feeder cattle, hogs, and orange juice. So what you can look for, again, are correlations. You probably wouldn't have guessed, well, maybe you would have guessed this. Lumber has a 91% positive correlation with the Dow. You can see there's the Dow for the x-axis. And then if you go to the y-axis, you see lumber, 91% positive correlation. That means 91% of the time over the last 6 months, those two have been moving together. It makes sense because the Dow is kind of representative of the economy to a certain extent. And if the economy is doing well, there's probably a lot of demand for lumber for construction. There you go. So that's how you can find some of these correlations between certain securities. Okay. Sorry, my dog's taking a little lick of her water right now, or his. Oops, lapping up. So you can do this again for different time frames. I typically stick with the 6 months. I want to see the long term. But one of the nice things is we can take a look to see between these 180 days and 30 days, is there a change in the correlation? Because as I mentioned, when correlations break down, we often see changes in trend coming. And look at that. We went from 91% to only 33%. So that's a warning sign that there may be a trend change coming. I don't know which security. Might be both, might be just one or the other, but there's a trend change coming potentially. So going back to 180 days, first of all, if anything's higher than 90% positive correlation, that's a high positive correlation, meaning those securities move very closely in line with each other. If it's negative 90 or lower, that means they move opposite of each other. Okay, so you'll see those are colored in red if it's negative 90 or lower. Positive 90 or higher is green. Okay, so that's for the correlation study. Now, if you want non-correlated securities, remember the first thing on our list was investment portfolio. We want non-correlated securities. So if we want a non-correlated securities, we need correlation between positive 10. Oops, what happened there? And negative 10. Do it again. So when we look for our portfolio, if we're looking long-term moves in the markets, we don't want to invest in things that are almost identical to each other. For instance, you wouldn't want to invest long-term in the NASDAQ and the Russell 2000. As you can see, they have a 94% positive correlation. But some other things you might not realize going across the screen, even here, copper has an 82% positive correlation with the NASDAQ, 95% with the S&P. So if you have long-term positions of both copper and the S&P or the NASDAQ, you're duplicating your efforts. You basically have the same risk on both of those securities rather than focusing on one that might be offering you the better opportunity. So you can consolidate your portfolio by narrowing your focus. Copper? Oh, sure. It actually makes real sense if you think about it. The reason why copper is, again, a construction material. The demand in copper goes up when the economies are doing well. And when economies and businesses are doing well, then their stocks do well. People buy that. So that's why there's a direct correlation. On average, copper and the equity markets have about an 85 to 95% positive correlation on average. That's long term. Okay. So there's definitely a positive correlation there. And yep. The other nice thing is, let's see, sorry. Getting some messages from some fellow instructors asking me to use some of my television connections. I'm a nice guy. I'm helping them out. All right. So anyway, yeah, you can take a look and see some of these correlations are out there you might not even think about. When you go to some of these commodities, for instance, lean hogs and the equity markets also have very high positive correlation. So if I'm investing in the stock markets in the US, the S&P, the NASDAQ, the Dow, I want to find something else that's non-related, so that way I'm diversifying my portfolio. Now, you probably won't find something that's completely uncorrelated to everything, but you try to do the best you can. So by looking across on that S&P column or row, excuse me, that's the second row, you can see we've got close on the Swissy. It's negative 14, but not quite. And you keep going across, and there you go. Cocoa has a negative 7% correlation with the S&P. So if you were to invest in cocoa and invest in the S&P 500, neither one of those has relationships to each other. They're not influencing each other, and therefore you are diversifying your portfolio properly. Again, it's not available to do it 100% of the time, being non-correlated with everybody, but you can find enough. So for instance, if I were looking at the NASDAQ, it looks like we got nat gas and cocoa as well are non-correlated. Yeah, OJ is negative 63. Now that means it moves opposite. And for some reason, that's been the case. The orange juice, are we doing 30? No, it's 180 days. Yeah. Yeah, you can even see probably last 30 days too. It gets pretty negative. Yep, that went positive. That's going to be a warning sign too. But on average, orange juice happens to move opposite of the equity markets. Now, because it's only negative 63, it means that's not a huge negative correlation. It's not like one moves up, the other moves down instantly. It's just overall, they're not as related to each other. So once again, if you're looking for diversification, the best would be between 10 and negative 10. 0 would obviously be best. We have a couple of ones here. Every once in a while, yep, there's a 0. So the US dollar has no correlation with the Japanese yen right now. That's it. I find that hard to believe, but that's the way it is for right now. That's a 0. So we can even confirm this, like I said, on different trading platforms that are out there. If I go to my trading platform, if I go to a chart of the dollar index, there we go, DXY. Probably have delayed data. This one, yeah, I do. That's okay. It's fine for daily. But what I can do now is I can add in right here. I can either do compare and bring in that symbol, which would be Japanese yen. See, as an index, let's see if we can find one. Nope. Now we'll just do the currency. That'll be fine. USD. I don't need that way. JPY. and you can just physically compare the charts. That's not really the best way to do it, but you can see they're kind of moving opposite of each other there on that daily chart. I'm not sure if that's the right one to be using, but we'll find out. Do this again, do Forex. There we go. That's probably better, much better. And they actually have broken off. As you can see, they were positively correlated for a while, but then broke off. That's not the best way to look at it. The best way to look at it is to use a technical indicator. Often in the different platforms you have, you will find a correlation study. So right here we have correlation coefficient. And I just have to change the symbol. And that's weird. We can try this one. See if that works. And you can see, yeah, it's not great correlation because it's back and forth. So once again, if I'm trying to confirm something that has a high correlation, and we saw this was not much of a correlation, but if we want a high correlation, we could try to put in two securities that are highly correlated. I mentioned NASDAQ and the Russell 2000. Okay, so we go out there, wrong button, right here. And I'll bring up the NASDAQ chart. Click the wrong button there. I'm just going to do continuous. There it is. I was doing some research on this a little bit earlier today. Now, when I go to my correlation chart, we change the security to the Russell. Here we go. And the length that it's doing is the last 20 days. We can do longer if we want. Remember, we're looking maybe at 180 days for correlation. And now what do you notice? It makes a big difference, doesn't it? When you don't look at short term, you look at long term, it makes a huge difference. So looking at the long term, you can see that there are definitely times where the correlation breaks down, but for the most part, it's a high positive correlation. As a matter of fact, if I put in a line here, you're looking at 90+% over the last 6 months right there. There it is. That's what you're seeing. And that's being confirmed. There you see Russell 2000 futures, NASDAQ futures, 94% positive correlation over the last 6 months. And you see it there. So what does that tell me? Well, it tells me that long term, I should invest in both the NASDAQ and the Russell because they move together. It's like the same thing. But this could also lead to some other opportunities. Like I said, confirmation. So correlations, again, we want between +10 and -10 in order to let us know they're not correlated. It is okay to expand to 50 and -50. You're still not getting the high positive correlation. As long as you're within between +50 and -50, you have some correlation, but not enough to really make it an issue when it comes to your investments. The closer you are to 10 and -10, the better off you probably are. Now, correlated securities can lead to another securities movement. That is a hit or miss at times. Sometimes it definitely happens, sometimes it doesn't. What we have to do first is figure out what securities move together. And one that I was talking about a little while ago was copper and the equity markets. So if we look at the S&P futures, and I'll change this. Let me clear my chart first. There we go. And we change this to copper futures. There we go. Did that go 180 days as well? Yes, it did. You can see that there are definitely times where there's breakdowns in the correlations and other times where it's very highly correlated. Right now, we're sitting at 95% positive correlation on the last 180 trading days. Right? So very high positive correlation. Now, if I do this a little differently, what I can do is bring in a comparison, NG, no, not NG, sorry, HG, copper futures. There we go. I had to do HG here too, right? Yeah, just making sure I did the right one. Now we can see that we've got a comparison using percentages over here. Well, that's fine, but I can also do it a little differently where I actually change, let's see, is it show? And that's what I want to do. That's not actually how I want to show it, but I'm going to go to a different platform because it shows a little better. What this is doing is comparing everything from wherever my left edge is. You notice that's 0 for the comparison chart, and that shows you how we're moving. But that's not really the best way to see it. So I'm going to go over to my other platform here, Thinkorswim. I got plenty to choose from. And what I'm going to do now is, again, go ES, /ES. There we are. That's the S&P 500, and we clear this. And now I can go ahead and compare under studies, compare with, and bring in a continuous chart of copper. And the reason why I want to bring it in here, and I'm going to get rid of this indicator for now. There we go. Fix that later. I'm thinking that line is a question. I don't know if I can. No, it doesn't let me do it. That's okay. I thought I could. But the reason why I have it this way now is you notice that the scales are on different sides. And you might even be able to separate them in panes so that way one's in one pane and one's in the other pane, meaning they're in separate boxes, one above the other. It's up to you. I'm going to go out to daily. Actually, I'm going to go to weekly, much longer time frame. And we're going to go back in time. There we are. And the reason why I want to do that, oops, did not mean to zoom in there, but that's okay. We go back in time here to 2007. Now, that may not be the easiest way to look at this, but when we were rallying to all-time highs in 2007, remember what I was saying here. Number 2 is correlated securities sometimes lead in others' movement. I talked about Cisco or Intel leading the S&P by 4 minutes. When it came to copper, copper led by several weeks compared to the S&P 500. Remember, it has anywhere from 85 to 95% positive correlations long-term. Copper is a commodity used in construction. It's used in manufacturing. It's used everywhere, right? So if there's a demand for copper, suffice it to say, the economy is strong. If there's a demand, if the demand for copper wanes, if it goes away, the economy is slowing down. How the economy is doing is a direct relationship to how the stock market's likely to do. So going to copper here in 2007, we can see we made a peak. Here we go. Made a peak right here in, I think it was April of 06, and started declining in April of 06. Well, obviously the stock market declined almost the exact same day there, didn't decline nearly as much. But here was the telling signal that started to let you know there was weakness in the economy. Take a look at how copper reacted later in that year. It did not go up like the S&P did it? The S&P was moving up to all-time new highs. Meanwhile, copper was actually forming a downtrend using those highs. It couldn't make the same highs it did before. That was our warning sign that things were getting weak and we might be turning down pretty soon. The initial mark was right here. What was that? April 30th? Yeah, April 30th. And then again, July, mid-July. So it goes forward and we made all-time highs in the stock market. Did we make all-time highs in copper? No, we didn't. That was a really good sign. There it is again. As a matter of fact, not only do we not make new highs, if I take away these vertical lines, you can see all we did was test the trend line. And that happened 1 week before the S&P's all-time highs. That was April 13th, 2007. Yeah, 2007. So that was a warning sign that this high is not going to be sustainable. There were other warning signs as well. And so I remember back then I was trading and I was on, visiting CNBC and doing commentary on that as well. And I was mentioning that things were going to go down. One of my friends was actually one of the first people on CNBC calling for the market crash. So I didn't draw that out properly, but you get the idea. You can see it's on a downtrend. So what happened? Market collapsed. Now it got interesting because eventually copper did try to rally a little bit before dying off. So, but you can see it made the same highs during a slight rally in the stock market, but because we couldn't sustain new highs and started dropping off, We dropped off right here in July or June of 2008. The big drop off happened in August of 2008 on the equity markets. The same thing happened at the bottom. Notice at the bottom, copper put in its bottom in December of 08 and then put in higher lows and more importantly, made a higher high in early March. That was the bottom of the equity markets, by the way, March 4th of 2008. So the bottoming out and the breaking to new highs warned us that the equity market was ready to rally. And there are several examples of this over the years. That was just the most extreme one. So everybody's probably wondering what's going on now, right? Well, right now, copper's still going up, yeah. But you can see here, we want to compare it to prior highs and see if it's still making new highs. You can see going back to 2019, what happened with copper again? Started making lower highs and couldn't maintain, right? Meanwhile, going into 2020, the equity markets were still going up. This is where we had a breakdown in the correlation, the divergence between those two. And what happened? The stock market rushed to catch up. How much of a lead did you have there? Plenty. That was January of 2020. This was the month later, actually almost a month and a half later. So moving forward here, you can see again, copper bottomed out about the same time as the markets. So when they bottomed out, they both rallied up together. And currently copper, if you look at the closer picture here, I'm focusing on the purple chart. Each one of these successive peaks has been higher, 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 higher. Uh-oh. So that happened May 24th, that week. We made a lower high in copper. This entire run to the upside that started was that back in March 23rd of last year. Yep, March 23rd. That entire run never saw copper making lower highs. What does that mean for the S&P? Well, I don't know. It could, based on history, mean that within the next week or two, we could possibly break down. Yes, exactly. As Serge is mentioning, he says, now we need a lower low. That's really the telltale sign. If we continue this with a lower low on copper on the weekly chart, that would be the death knell for the bullish move in the equity markets, most likely. It should precede a turn to the downside. Now, it's not saying it's going to happen. You can't set your watch by it, but it's a warning sign that if you're long-term in the equity markets, buying and investing long, you might want to start looking into some protection for your 401k and your IRA, right? It's just a clue. That's all. So that's why I look at some of these related markets. If I just go out to copper itself, remove that, I can go into HG, for which contract we're on. Let's use a continuous. July is right now. Okay. And you can see on the weekly, let me clean this out. Excuse me. We haven't really broken down at all. All we did was just a little bit of a pullback here. It's not that big of a deal yet. Let me add in my study here, because I do use RSI with a lot of my indicator or with my price action read stuff. Yeah, we're just losing momentum right now. We haven't actually done any lower highs or lower lows yet. You know, on the line chart, it looks a little bit more distressing here, just showing pullback. And it's not showing any kind of reversal trend or anything like that. Excuse me there. But if we do fail to make new highs coming up and we make lower lows, I would be looking to see what's going to happen with the S&P at that point, because there's a high possibility of it doing that. Daily chart, same thing. You can see that recently we made a lower high. Okay. There wasn't a real warning sign before this, but we just basically tried to come back up and we hit a small little supply zone right there. Okay, this is kind of nice. I've got the indicator that tells me where my zones are. So if we're going to move down, our next demand zone is right there. There we go. So currently, that's what we're likely to do on the daily chart. Once again, what does that tell us when it comes to the S&P? Well, we're making lower highs and lower lows on the chart here. Let's see. Okay. We're making lower lows and lower highs on the copper chart. That means that on the ES, if we're starting to see some weakness, we may see a continuation to the downside pretty soon. That's it. It's just a warning. So that's kind of neat that we can use that. Like I was saying, correlated securities can lead to another's movement. So this comes by looking at, you need securities historically correlated by probably, I would say, 85% or more. Okay, so again, this is something I talk about quite a bit, and well, not quite a bit, but I do talk about it when we start looking at some larger timeframes when it comes to the E-mini think tank. I do a lot of this stuff in the work with futures, obviously, but it also affects you in the stock market. So if you're not in the E-mini think tank and you want to join me, by all means, you can go ahead and do that. We'll put the link in the chat for you as well. But some of the other things we can do is look for confidence. It doesn't matter if you're a stock trader, because the stocks follow the broad indexes, right? And when it comes to stock trading, the ETFs, we go back over here. There it is. We have either for futures traders, we have ES, NQ, YM, or RTY, right? If you're a stock trader, however, then you have SPY. Oh, what happened there? SPY, QQQ, DIA, and IWM. So those are securities, ETFs, that a lot of times will influence your individual stocks. And again, you can look at that to see how much of your stock, how much does it correlate to the broad market. So if I were to bring up, for instance, QQQ for the NASDAQ, I could use the correlation study here and take a look to see how much does Tesla correlate to the broad market. And make sure that's still in the long term. Yep, it is. So it's not the highest. It's about 80% positive correlation recently, ever since 2020. So about a year and a half of positive correlation there. Well, that means that if the market's moving for maybe moving down, then your stock is likely to be moving to the downside and vice versa. So you can take a look at that to see which ones are correlated. The way I use this, though, is I know that the equity markets are all very highly correlated. What I don't know is which one is going to lead for the day. So when I go back to my charts here, what you'll see at the very top row, I have my equity markets: Russell, Dow, NASDAQ, and S&P 500. But this chart is the one I look at in the mornings to let me know who is in charge. You can do this on any time frame. Okay. So what happens is if I go to a 5-minute chart in the morning, when the bell rings at 9:30, I zero all these out. And what happened there? There we go. Everything's zeroed out at 9:30 this morning now. What that does, it tells me who is leading us in whichever direction. I call it follow the leader. I think I've talked about this in a previous Coach's Corner, I'm not sure. But what happens is if the leader is the NASDAQ, then the markets will continue to rise and follow that leader. You see it happen this morning when they were moving off the lows, except the Russell was kind of on its own. But the S&P and the Dow were following the NASDAQ until the NASDAQ flattened out and couldn't make any new highs right there. Not only did it not make any new highs, it made a new low. And that's basically where you're seeing the other markets give up as well. That may have happened at a supply zone. That was at what, 11:20 a.m.? So if I look at the NASDAQ, clear this chart. And let's see. If I go back, the 11:10 a.m. Yeah, it's pretty much there. It wasn't necessarily a great supply zone, but you did have this rally-based drop, which could have been the origin of your selling pressure. Here we go. I did talk about it in previous Coach Corner. Cool. Yeah. So if I keep going back, there may have been a zone there as well. Oops. Yep, there it was. But this has been tested. Anyway, what happened was the NASDAQ hit a zone. Now the S&P may not have, but because the leader hit, that's where the other ones are likely to turn. So if I take a look at the S&P and do the same thing where I look for a zone, come on, there you go. Look back. You can see that there's really not much of a zone here. There's just a move and a move. So why did it turn where it did? Because the leader did. That's all. And you can do that with any security or any group of securities. I have it here as well, which is kind of nice because on this one, I actually have labels on them. Oops, wrong button. There we go. So here I can do it. Remember, we had a low on, what was it, March 23rd of last year. So if I take this back, it's actually using the M contract, so it won't go back that far. But if I did continuous contracts, I could actually use this and zero everything out. You can see right there, March 23rd was the low of the markets and everything moved up. But which one was the leader? The Russell. So if I want to know, let me just change this to a continuous contract. There we go. The reason why I did that is it wasn't being shown. So if I zero everything out at the beginning of the move up, which is March 23rd, get that over there. There we are. Now I can see we kept moving up until the leader gave up. Right here is the Russell making a high. Didn't make a lower low yet, but it's making lower highs. Can't seem to get up to where it was before. And even though the rest of these are being dragged to the upside, if the Russell starts moving down, it's likely to cause everything else to turn to the downside. So that's another use for this correlation, is looking for confidence in a trade. If I see that two positively correlated securities, not even just the leading thing, if I just look for positively correlated securities, oops, wrong page, and they're both hitting demand or supply at the same time, there's a higher probability the trade's going to work. That's all. So if we take a look at Canadian dollar and British pound, they have a 93% positive correlation between Canadian dollar and British pound. Well, I can take a look at my charts here, and we can take a look at British pound futures. / right there. And I can also look at the Canadian dollar futures. I'll do add study, compare with. Here we are. Although I probably want a line chart for that, or a candlestick chart anyway, but it was 6C. There we are. You can actually do that. It gets kind of confusing if you have two candles on top of each other. That's the only problem. But I could see that the Canadian dollar is showing a very similar pattern to British pound. British pound happens to have a little buy zone right there, demand zone, rally-based rally. So as we come down, if I see the Canadian dollars bouncing at the same time the pound is, because they have a high positive correlation, that's a higher odds that my trade is going to work. Now, I don't have a demand zone on the Canadian dollar. I only had one on the pound. That reduces the probability of my trade working out. If they both had zones at the same area and we're hitting them at the same time, I'd feel more confident. But because they don't, that's a takeaway. It reduces the possibility of this working out. Does that make sense, hopefully? So that's what I'm doing there with the correlated securities offering confidence. Highly correlated securities should bounce from zones at the same time. That gives you a higher probability of the trade working out, like I was saying. Now, another thing we can do is look for cheap. You know, what is cheaper to trade? I keep going on the wrong page. Here we go. Start off there. Let me see if I have this picture. Saved a couple of these. This is just a picture I had saved from a previous talk about correlations. Some of the uses, as I mentioned, odds enhancement. We'll get to major trend change soon, but we can find non-correlated securities for investment, and we can even find a substitute. So that's what I want to look at here for a substitute. We talked about that earlier when I showed you using the Aussie yen as a substitute for the S&P 500. So a couple things. If you have a positive correlation, securities move together. Inverse or negative correlation, they move opposite. And the third opportunity is no correlation, meaning they have no relationship to each other. Now, when we're looking at currencies, we have two different currencies that we can deal with. One is called the base currency and the other is called the quote currency. The base currency is the first one that is in your pair. The quote is the second. So the base currency is being quoted in the second currency. Now, you have to figure out which one's positively correlated, which one's negatively correlated. You want to trade one against the other to substitute a security. So as mentioned, the Australian dollar, Japanese yen. Well, it's Aussie base yen quote. If the Aussie is positively correlated with the S&P, that means the yen should be negatively correlated. Those charts would move identical to each other. Okay, so as I go as an example here, I missed it. Here, I can look at my securities and I can look at the currencies. The Australian dollars right here, and you can see it has an 86% positive correlation with the S&P 500. We'll zoom in a little more. There you go. So ES, AD, 86, even 84 for the Dow, 89 for the NASDAQ. Japanese yen, however, moves opposite of the S&P. So what we're looking at is a pair like this. The Aussie base is positive, the negative Japanese yen, that means that the chart should be identical to each other. If we find the base is opposite and the quote is positive, then the two charts will be inverse of each other. An example of that, you zoom out a little bit so we can see it. There it is, crude oil. You take crude oil and work your way across, you can see that crude oil moves with the Canadian dollar 92% of the time. Right there, Canadian dollar and the crude oil. The US dollar moves against the crude oil 54% of the time. So for the currency pair, we do USD JPY. That means the US dollar is the quote, base, yen is the quote, or Canadian dollar is the quote. So what does that mean? If the base is negative, the quote is positive, those two charts will be opposite of each other. Let's see. First, we shrink this back down. Wrong one. Right here. We can use crude oil, right? Let me just remove my drawings here, clean it up. It's on a daily chart. That's fine. And I can even use a correlation study here and put in Forex, USD, JPY. And then also insert it right here. Compare. This is giving me a little trouble here, isn't it? I'm about to do on the other platform. You can do it anywhere, it doesn't matter. There we go, JPY. And got that weird spike in crude oil, so I'm going to kind of move beyond the spike, I suppose. Oh, you know what? I don't want to do it on this page anyway. I want to do it on the other one. So once again, if I do crude oil continuous, and I'm going to go to a bigger time frame, even smaller time frames will work on some of these, and compare. Again to USD, JPY. There I go. All kinds of technical issues here. There we go. And once again, I can get rid of this RSI and bring in the correlation study on this platform. So let's see, is there one there? No, I gotta go here. Correlation. And you gotta change the security. That's an important thing. There we go. And I should be able to see a positive correlation between these two. It's kind of off a little bit. It's only 64% right now, but you can see that with a few exceptions, these two do tend to move together. Or sorry, not together. It should be opposite. It's kind of weird. They're actually moving together here. There is opposite movement there, but recently they started moving together. That's actually unusual because we should be seeing a move opposite of each other. Strange. Oh, because you know what? I got the wrong security. Silly. USD CAD. I don't know why I put in yen. I was thinking something else. And why is that not showing? What the heck? Compare with USD CAD. There. And I want it as percent. Yeah. Okay. Let's see if I can fix this. Just do a new chart. It's not a big deal. I'm going to take that off that drawing mode. Apologize. Sorry. So once again, we can do CL, crude oil, and hopefully compare it. Studies. Dollar CAD. There we go. And remove this. So come on, well, let me remove now. There it goes. Whew. Anyway, now it should look opposite. And we can take this out to a daily time frame. Perfect. That's better. That's what I was looking for. It's going to be persistent with what you want. Of course, I can also bring in the correlation study as well. And the whole reason why I'm bringing this up is, again, I'm trying to use substitutes. If I don't want to spend the margin on CL or QM, I can go ahead and use it by trading USD, CAD, and I get a better opportunity, less margin. See if that works. There we go. And you can see for the most part, they're negatively correlated. Definitely see it on the chart as they're moving in opposite directions, right? But you also can see that we're going below zero quite often, negatively correlated. Actually, forgot to make one change on that. That is going back 10. Remember, I want to go back 180 days. And now you're seeing that negative correlation. Okay. Or the other one I was mentioning, the S&P 500 and the Aussie yen. There we go. And again, if I bring in the correlation study, I got to change to the right security, AUD, JPY. And you can see those two charts look very similar to each other, don't they? So I have the opportunity of trading the S&P 500 or the opportunity of trading the Aussie yen. Why would I want to trade the Aussie yen? Well, it could be a money issue. Perhaps I want to trade using less money. So it was an ESM 2021. I think that's where I had the notes. There they are. As you can see, I can trade for as little as $15, and even the micro on the futures doesn't get you that cheap. So now if I want to take some real trades and take advantage of some moves, say for instance, tomorrow morning, or no, sorry, no, it wasn't tomorrow morning, today, it was the non-farm payroll news that came out this morning. But I may not want to take the risk of the micros, right? So if I go, actually, I'll just keep it here. On the micros, maybe not. If I went down to a 5-minute chart, Non-farm payroll was 8:30 this morning, and I wanted to take an opportunity to trade this perhaps for a breakout. You can see that prices were moving just sideways prior to the news. And by the way, in the E-mini think tank, I have detailed information on how to trade things like this with the news. I have a whole setup and manners to trade that. As I mentioned, if you go to, let's see, where's it here? Wealth Builders HQ. How often do I do the comparison? It depends on what it is I'm trying to do for my trading, to be honest with you. You know, you can do it monthly. It doesn't change that often if you're looking at long-term moves in the markets. However, for, you know, substitution purposes, it's whenever you want to make a trade, for instance. So if I wanted to trade the non-farm payroll this morning, but I didn't want to have to cough up the $1,500 for margin or whatever it is intraday, $100, I wanted to get away with smaller and less risk. Right here, if I go to my E-mini think tank, and again, you've got the link there if you want to join me for that. You can go into the E-mini think tank, and some of the tools I have under bonus videos, I actually have strategies on news. So where is it here? No, it's in there somewhere. Yeah, there it is. E-mini opening range and news breakout fade trades. So if you join us from the E-mini think tank, you'll actually get all those strategies and how I trade those. So there's a recording on that and how to do it. Now we do it every day for the most part in the live action, in the live trading sessions we do. And there's also documentation on it as well. So if you go to the fundamentals, I'm not sure if it's under that one or if it's there is news strategy. There's all the news strategy, how to actually trade it and set up your orders. So I got all that information for my students there. Oops, I was on the right page. So going back this morning, what happened was the non-farm payroll, we would have set this up to capture this move on the breakout. And you can see it exploded to the upside. And we had a move of about 15 points on the S&P. So what was that? About $750 worth of profit if you caught that 41.95 to 42.10. However, if you didn't want to take as much risk that you would have had on this market, which let's see what the risk would have been, 95 to 92, we're talking about 3 points. So we'll call it 4 points of risk or $200 of risk. Not bad, right? You probably could have done it for less. We'll say $200 of risk. Instead, we could have traded AUD JPY in the Forex market, same time, right? 825. And now we can reduce our risk. The reason why we can reduce our risk is we don't have to trade standard lots. So the difference here is 5 pips. Okay, well, 5 pips on the standard lot, we'll call it maybe more. We'll say, even if it's 10 pips, that's $100 of risk on a standard lot. So I went from putting up margin, even intraday, the margins are, depending on where you trade, could be kind of high on the S&P futures. Did I get rid of all the text I had? I hope I didn't. Oh, there it is. So we have margin of 12,000, but intraday, obviously it drops. Or let me see exactly what it is. Go into come on. And margins. Just want to get an idea of what we're looking at here. All right. So if I was trading the S&P 500 futures intraday full-size contract, you get a pretty good discount, $750 for margin. And the micros, obviously going to be cheap. That's about $100. But still, if you didn't want to take that much risk, remember, that's the margin to put up. The stop loss and the risk was $200 on the full-size contract, no matter what you did. So we'll compare these again. 700 intraday with 200 risk. Okay, the margin obviously goes down to $100 with, and that would have been, I think, $20 risk. Yeah, it's 1/10. So $20 of risk. Now, if we did the standard lot here, we had less risk. It's $15.50, but we only risked $100 using 10 pips. And we could have made it smaller. It didn't have to be that large. On the mini lots, $155 of margin, and the risk would have been $10. So here with the micro, you would have used $15 with the risk of basically $1. And you could have participated in that big move to make a profit using less capital to participate and having less risk. Now, that's just one example, but there are many examples out there where you can use currencies, or you can even find individual ETFs or securities. Now, you couldn't have traded the news on the ETFs because they don't trade as well pre-market. You can't put in stop losses. You got to do things differently there. But on regular trading hours, if you want to substitute, you can substitute stocks or even ETFs to trade individual futures. And it may be cheaper because you can use a couple of shares rather than doing 100 shares or 500 shares or a futures contract. So that's one of the advantages of knowing how these intermarket relationships are. The last one, which I really don't have much time for, I'm already over my time here, is breakdown and correlations often precede changes. Okay, so we saw correlated securities offer cheaper trading. You know, we basically substitute forex for futures, lower margin and risk. And of course, you also get lower profits. But breakdowns and correlations also often precede trend changes. You need high positive correlations between securities. And what can happen, I'll use this example here. We have the NASDAQ on the daily chart, and I'm going to bring up the Dow. Again, on the daily chart. And you can see those are very positively correlated, right? Let's do a weekly chart, actually. Probably even better. There you go. So it's not showing the breakdown as much. It's kind of weird. It was better on my other charts. We'll see if they want to work today. So if I go out to the continuous contract, ES, let's try that. And again, weekly. And bring in the correlation of the YM. Okay. What you see is long-term, that's a pretty high positive correlation, isn't it? It almost looks like it's a solid line, but it's really not. There are dips. So that's what we want to take a look at. Where there are changes in correlation, typically there are going to be changes in trend. And it may not be as visible here on the weekly because you really aren't seeing much of a difference, right? So maybe to fine tune this, we go down to a daily. Or not. It's still showing 99, right? Wow. Very high positive correlation. Okay, but there are some examples here from time to time. Again, this is not something that happens that often, but when it does, it could be beneficial. There we go. Right here, you can see that we were normally experiencing a very high positive correlation. Maybe if this thing leaves me alone. Come on, you got to be kidding me. Right there, close to 100%. Let's bring that up higher so you can see it. And what happened? We broke down all the way to about 81% positive correlation. And what happened when that broke down? First of all, the correlation started breaking right there. Look at that. It didn't happen after the crash, did it? We were moving along sideways and had been bullish prior to this. And we dropped from a 90+% correlation to 80% over the last 180 days. What is that telling you? As I mentioned, when you have very high positive correlations like this, when those correlations break down, trend change is imminent. And what happened? Trend change, didn't it? So we go forward. We're at very high positive correlation. It's not going to catch everyone, by the way. Still, look at this. We're 99% positive correlation. Keep moving. We're not. Oh, we're breaking down. Come on, it just jumped. There it is. Notice we're at 97 now. Not a big jump, but we're breaking down 96, 95. That's a warning sign that we may be getting a trend change pretty soon. Typically, it's going to have to go more than that. For the, you really want to see a 90% or positive going down to 85 or 80%. If that's the case, you are almost always going to have a trend change coming. So there didn't really do much, didn't go down that much. But yeah, we didn't really see much of a trend change either. We're still bullish. See if we get another one coming up. I'm in 2017, by the way. And maybe I've got this too long. You know, I could be a little less sensitive with this. Oh, here's another one. Here we are in 2018. Oh, come on. And let's see if we dip in the 80s. We're at 90. What happened to it? Come on. It's getting annoying. What was that? Did I miss it? Here's 2019. Again, dipping down a little bit. Didn't get in the 80s yet. And maybe that's not the time frame, or it's too not sensitive enough. So let's go back here. Oh, so annoying. And change that to 30 days and see if we get more sensitivity on the indicator. So let's say we're going to put this line not at 81, but at 85%, or we'll do if it breaks below 90. Why is it not showing up front? Okay. So now if I go back in time a little bit, I don't want to go too far back, but you can see if we break below 90%, that may be a warning sign that trend is changing. And there's a breakdown. And we actually did change trend. We were moving somewhat down and sideways, and we accelerated to the upside when that broke 80 or broke into the 80s. We move along again. Missed that one. Again, it's not perfect. It's just an odds enhancer. Here we were very choppy and moving sideways. We have now broken below 90. We should expect a rally coming soon, or some sort of a move on the trend. Oh, come on. Is this one right here? So we're kind of actually higher lows, higher highs. Broke below 90 right there, 89. So that's warning. And there's the trend change. Look at that, it came down. Made new lows. Moving along. Oh, another one. Went too fast. I don't know what is going on with that today. There we are again. You get the idea though. Anytime it dips below 89 or 90, you start to see trend changes. It's just an odds enhancer. It's not a great way to time things. Here's another one. We get back to 89 right there. So right there is where it's moving. Next thing you know, dropped. So it is pretty timely. And you can do this on any two securities that are highly correlated like that. Let's go to correlation study. Some commodities maybe. Crude oil and Brent, they're very highly positively correlated, right? You've got 100% between crude oil and Brent. So let's see if I can look at those two. Oh, wrong page. I bring in crude oil. Come on, you gotta be kidding me. So there's crude oil, and if we change this to Brent, it's one. There we go. We can do the same thing. We can look to see when is there a breakdown in correlation that could lead to a change in trend. And we got to figure out overall, what is that number as well? Is it 90%? Is it 80%? You know, where's that magic number that tells us when the trend is changing? So it takes a little bit of detective work to do this, but it can give you an idea long-term. This doesn't work intraday, by the way. This is for long-term analysis. But once again, as I go forward, there we go. We broke down in correlation 89. We're in a bit of a downtrend here, so we should expect a reversal soon. And look at that. We bottomed out. That was a negative move in the markets, and we changed trend, didn't we? Went back up. So moving forward here, we're playing with 89. We're at 90. Nope, it didn't go below. Come on. Oh, I just went to the hard right edge. Anyway, that, yeah, it didn't give me any more. But you can do the same thing with any positively correlated securities. And if you go back in time and test this, again, right here, you've got another breakdown at 89. And what's happening right there? well, we're kind of moving a bit sideways overall downtrend that may be telling us that we're going to turn around and possibly move up soon. And we did. Look at that. We had this long-term downtrend. Come on. So frustrating. Right there. Long-term downtrend. And as soon as we did that, dip below 90, we ended up making higher lows and higher highs and changed the overall trend back upwards. Isn't that powerful? Again, it doesn't tell you which day or which week or which minute is going to happen, but it tells you to watch out because it's likely to occur. Here's another one occurring now. Right here, we have the same thing going on, this time in an uptrend. You can see we're dipping below 90. We should expect some sort of a trend change. So far, we've been in an uptrend. It was a false alarm. Maybe, maybe not, actually. You can argue that, you know what, we were kind of sideways here. And when that happened, we resumed the uptrend. You know, it's kind of pushing it, but maybe. And just keep looking. There's another breakdown right here. 89. It's frustrating me. So right there is a breakdown 89. We should expect a trend change, and we started dropping. Had a little bit of a dip at that point right here. So like I said, it's a timing thing that you can use this to let you know when trends might be changing. So I've gone over my hour here quite a bit. So if you got any questions, let me know. If not, I would love to see you in the E-mini think tank, as that is where I am 3 days a week, Monday, Wednesdays, and Thursdays from 9 a.m. to 11 a.m. I do a lot of this information. Also, feel free to follow me. I'm on Twitter at TraderBDub. You can follow me there. On Facebook, you can find me at Brandon Wendell, CMT. I'm a charter market technician, so I'm proud about that. So you can find me there too. And until then, if I see you again online, let me know. I'd love to see you guys there. Like I said, the E-mini think tank. You can join me on a month-to-month subscription if you want to. That is, I think, $3.99 a month. If you want to join me on a quarterly subscription, we give you a bit of a discount. It's $9.95 a quarter. But you can try us all out for free for the first 2 weeks. You get all my strategies. You get me giving you some live updates in the markets on 3 days a week, 9 a.m. to 11 a.m., Monday, Wednesdays, Thursdays, as well as trade ideas. I come up with anywhere from 4 to 8 trade ideas every single session. And tracking those trade ideas over the past year, we haven't had a losing month. So we've had pretty good rates of returns in those trade ideas. Plus, we also, again, have ideas we find during the regular days. So if there's any questions, I'll stick around to answer those. And if not, have a great weekend. And I've got some work to do, but I'm going to be relaxing this weekend and maybe going doing some kayaking in the backyard here. I live on a river. It's not the backyard of grass. I actually live on a canal that connects out to the ocean. But thank you for being here, everybody. Not seeing any questions, just a lot of thanks. And thank you for your time. I appreciate it. Actually, I got to make some lunch too. Well, again, thank you for being here.